When we think of high inflation, we often think of the 1970s. I use 3-month Treasury bills as a proxy for short-term rates here because the data set goes back really far. But essentially what you had here was the Federal Reserve was constantly trying to tighten and raise rates to rein in inflation. And they were able to do that in large part because debt as a percentage of GDP, both in the public debt and private debt, including household debt, corporate debt, all these different types of debt outstanding, they were pretty low. And so they were able to raise rates, and it caused economic weakness, didn't necessarily cause like a solvency event. Whereas back in the 1940s was the last time debt as a percentage of GDP was as high as it is now. You had a pretty big decoupling in terms of inflation and interest rate policy. And so I think a lot of macro indicators show that the 2020s are shaping up to be very similar. We already had this big spike here. We had the largest ever decoupling in terms of inflation and rates since the 1950s. And I think we're going to get probably more cycles of that going forward.